part of the reason there are going to be plenty of opportunities is other people doing dumb things.
According to billionaire Warren Buffett, this is arguably the most challenging environment of Buffett's investing career. That is saying something pretty extreme considering Buffett has been investing since 1942 when he bought his first stock at just 11 years old. Warren Buffett has invested through everything from economic panics to stock market bubbles. However, today's stock market is the most difficult ever for finding attractive opportunities. There are two huge forces that are acting on the stock market and economy today that you need to know about that we will cover shortly. However, it's not all bad news. As you will see, Buffett is still confident that if you do just a few things right, you can still build incredible wealth in the stock market. Make sure to stick around till the end of the video as I have a special treat for those that watch this entire video. Let's get into it. The first issue impacting investors today is higher interest rates. As you can see on this chart here, U.S. investors are being forced to deal with high interest rates. Between 2009 and 2022, interest rates were essentially zero for the majority of that time period. However, the Federal Reserve began raising rates from near zero in March 2022 to combat rising inflation. Over the course of approximately 16 months, the Fed implemented a series of rate hikes, culminating in July 2023 when the federal funds rate reached a target range of 5.25 to 5.50. This marked an increase of 5.25 percentage points from the initial rate. This rapid series of rate hikes was the most aggressive tightening cycle by the Federal Reserve in decades, aiming to address the highest inflation rates the U.S. had experienced since the early 1980s. We have seen a few rate cuts recently with the U.S. Fed funds rate now hovering around 4.75%. However, as you can see, this is still well above what investors had gotten accustomed to. This is extremely important because interest rates act essentially as gravity for stock prices. Listen to Buffett explain the analogy.
Interest rates, basically are to the value of assets what gravity is to matter. If I could reduce gravity pull by about 80%, I'd be in the Tokyo Olympics jumping.
Higher interest rates act like gravity on stock prices, pulling them back down to earth. Stocks are valued based on the present value of their future cash flow. When interest rates rise, the discount rate used to value that future cash flow increases, making the stock worth less today. This may sound complicated, but trust me, it's actually pretty straightforward. Here is a quick example to demonstrate. Let's say you have a stock that generates $10 a year in cash flow for 10 years. At the end of the 10 years, you can sell that stock for a 15 times multiple of the annual cash flow. That would get you $150 when you go and sell the stock at the end of 10 years. Now that you know how much cash the stock will generate for you as the owner, determining how much that stock is worth today is highly dependent on the interest rate. This is due to a concept known as the time value of money. If you had to choose between getting $1,000 today or $1,000 20 years from now, what would you pick? You, of course, would pick the money today. As interest rates increase, so does what is referred to as the discount rate. Think of this as the higher return investors demand for waiting to receive future cash flows. Let's see this play out in real time. At a 3% discount rate, the value of our example stock is $197 per share. However, let's see what happens though as interest rates increase. Let's take the discount rate up to 7% and see what happens. At a 7% discount rate, the value of the stock drops to $146 per share. This is a 35% reduction from the previous stock price of $197. For the sake of this example, let's get really extreme and bring the discount rate all the way up to 10%. This causes the value of the stock to plunge even further, all the way down to $119 a share. A massive drop of 66% from the $197 a share at the 3% discount rate. This is exactly what Buffett means when he says that rising interest rates are like gravity on stock prices. Comparing the impact of rising interest rates on stocks to gravity is an example of a mental model. A mental model is a framework or way of thinking that helps you understand how the world works, make decisions, and solve problems more effectively. Mental models have been incredibly important in Warren Buffett's investing career, many of which Buffett learned from his legendary business partner, Charlie Munger. As a thank you for supporting the channel, I compiled an exclusive list of Charlie Munger's best mental models to help you invest successfully. This is completely free and is my gift to you just for watching this video. Make sure to download your free copy at the link in the description of this video because learning these concepts has been incredibly helpful in my wealth building journey. and I'm sure they will be for you too. Let's get back into the video. What is making things so challenging for investors right now is that despite interest rates remaining at the highest levels in nearly 2 decades, the stock market continues to hit record highs. Take a look at this graph here. The blue line is the S&P 500 index, largely considered the best proxy for the U.S. stock market. The orange bars are interest rates. You can see that in 2022, as interest rates started to climb, the stock market sold off as a result. Buffett used the sell-off as a buying opportunity, spending $68 billion acquiring shares in companies. However, what has been confusing is how the stock market has reacted after the initial sell-off in 2022. Despite interest rates continuing to climb, the stock market has soared more than 70% from the lows hit in 2022. This leads directly into the second challenge investors are currently facing in the stock market: sky-high valuations. Let's see what Buffett's favorite stock market valuation metric has to say about the current state of the stock market. Warren Buffett has coined a valuation metric known as the Buffett indicator. In previous interviews, Buffett has referred to this metric as the single best valuation metric for the stock market. Once you see what the Buffett indicator is saying about the current state of the stock market, you'll understand why Buffett has been selling tens of billions of dollars worth of stocks. To calculate the Buffett indicator, you have to take the current value of the U.S. stock market and divide it by the current size of the U.S. economy. The higher the number for the Buffett indicator, the more potentially overvalued the stock market. As of the making of this video, the current value of the U.S. stock market was $62.29 trillion. The size of the U.S. economy, as measured by gross domestic product, was $29.55 trillion. Dividing the current value of the stock market by the economy gives us a Buffett indicator reading of 211%. Are you ready for a shocking surprise? This reading of 211% for the Buffett indicator is the single highest reading for the metric since the data started being tracked nearly 75 years ago. This means the U.S. stock market would have to fall by a whopping 40% in order to be considered fairly valued relative to historical levels. With this context, it is not surprising that Buffett has been selling tens of billions of dollars worth of stocks. In 2023, Warren Buffett, through his firm Berkshire Hathaway, was a net seller of stocks to the tune of $24 billion. As the stock market continued to climb, that number skyrocketed to $139 billion in 2024. Over the last 2 years, Buffett has reduced his exposure to stocks by a staggering $163 billion. Listen to what Buffett had to say about why he was piling so much cash as recently as at last year's annual shareholder meeting.
You're sitting on $168 billion of cash. One, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%.
The combination of higher interest rates and elevated valuations have created a challenging dynamic in the current stock market. As Buffett just described, it can feel discouraging because it just doesn't seem like there are a ton of great opportunities in today's market. However, fortunately for us, if we read between the lines, there are 3 lessons we can take away from Warren Buffett on how to navigate this treacherous market. The first piece of advice from Buffett is to have a larger portion of your investment portfolio in bonds. Listen to Buffett explain.
I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world, we find it quite attractive.
The first lesson we can learn from Buffett's action is when things in the stock market, economy, and frankly the world appear shaky, don't forget about bonds. When Buffett says he doesn't mind holding more cash currently, what he actually means is holding that cash in short-term treasury bonds. At the end of 2023, Buffett had $130 billion in short-term treasury bonds. At the end of 2024, that number had ballooned to a staggering nearly $287 billion. Looking at it a different way, at the end of 2023, 65% of Buffett's portfolio was in stocks and 35% was in bonds. However, things changed dramatically over the course of just 12 months. At the end of 2024, only 44% of Buffett's portfolio was in stocks and a whopping 56% in bonds. This is the lowest percentage of Buffett's portfolio that has been in stocks in 20 years. This is a playbook Buffett has followed his entire career and something he learned from his mentor, Ben Graham, author of the legendary investing book, The Intelligent Investor. One of the core concepts of the book is that investors should fluctuate the mix of stocks and bonds in their portfolio based on the current valuation of the stock market. When stock prices are low and opportunities plentiful, investors should sell bonds and buy more stocks. However, when stock prices soar and valuations look less attractive, investors should sell stocks and buy bonds instead. As an added bonus, yields on bonds are at some of their highest levels in decades. Yields on short-term U.S. government bonds are in the 4 to 5% range. While this may not seem like much, it was only a few years ago when they were at essentially 0%. With these higher interest rates, for the first time in years, investors are getting paid to own bonds. The second piece of advice from Buffett is to look outside of large U.S. stocks for potentially attractive opportunities. This is exactly something Buffett did recently with his investment in the Japanese trading houses. Buffett invested over $6 billion into these companies, an investment that, in dollar terms, has quickly become one of the most profitable of Buffett's storied investment career. Listen to him explain.
I was looking at company after company, as I'll do every day, and I just thought these were big companies. They were companies that I generally understood what they did, and they were selling at what I thought was a ridiculous price, particularly the price compared to the interest rates prevailing at that time.
Much of the focus from investors is on the so-called Magnificent Seven stocks. Many investors are frustrated as there doesn't appear to be much in the way of attractive opportunities in today's market, as these companies appear to be trading at sky-high valuations. However, if you expand your horizon beyond just the very largest American stocks, you could be in for a very pleasant surprise. As of the making of this video, the U.S. stock market trades at a P/E ratio of over 26 times. By far the highest of any major stock market by a significant margin. However, other large economies with very solid companies trade at much more attractive P/E ratios. Australia trades at around 21 times, France at 19 times, Germany at 18 times, the UK at 17 times, Japan at 15 times, and Italy at 11 times. These lower P/E ratios are a signal that there could be interesting opportunities for investors who are willing to look outside the United States. This dynamic extends beyond just geography. There is also a stark valuation gap when you look at stocks based on their size as measured by market cap. So-called small-cap stocks are generally considered companies with a market cap between $300 million and $2 billion. Mid-cap stocks typically have a market cap between $2 billion and $10 billion. As you can see in these charts here, the P/E ratio for small and mid-cap companies is at its biggest discount to the S&P 500 in more than 20 years. This goes to show that there is plenty of opportunity out there for investors that are willing to look beyond just the very largest American companies. The third and arguably most important lesson from Buffett on how to invest successfully during these challenging times is to resist the urge to speculate. Buffett has said that there is no worse feeling for a person than to watch their neighbor get rich investing in the stock market. A stock market trading at or near all-time highs can create a FOMO effect that makes people start treating the stock market like a casino.
Well, the stock market, we've had a lot of people into the casino in the last year. You have millions and billions of people who have set up accounts where they day trade, where they're selling puts and calls, where they, I would say that you had the greatest increase in the number of gamblers, essentially, and conditions lead to this place where more people are entering the casino than are leaving every day, and it creates its own reality for a while, and nobody tells you when the clock's going to strike 12 and it all turns to pumpkins and mice. This is about as extreme as we've seen it, isn't it, Charlie?
Investing with all the craziness of 2025 is definitely a challenge. To help you navigate everything, I have a completely free thank you gift for making it this far in the video. The exclusive Warren Buffett investment checklist. I've done all the hard work for you and put together the Warren Buffett investment checklist that you can download for completely free at the link in the description of this video. Make sure to check it out because it's my gift to you for supporting the channel. Also, if you enjoyed this video, make sure to check out Warren Buffett, How to Invest Small Sums of Money, because with nearly 500,000 views, people are finding it incredibly helpful. I'm sure you will too, and I will see you over there.